Hi, everybody. This is our last speaker session before we'll give it to Lance to close it out. But we're going to talk about BTR some more. Today I'm joined by Jaime Arouh. He's the managing director of the institutional group at LendingOne. And I know we have some lovely charts to accompany this one. There they are. So, Jaime, thank you so much for being here.
Thank you.
To kick us off, we'll start with a chart. We'll zoom out a little bit. I want to focus on this bar chart actually right here on your, this is annual BTR deliveries along with a little bit of a forecast. And you can see just how the space has evolved tremendously over the past few years. 2015, we're at 3.8K deliveries. Now we're at, 40K, a little bit over that, and they're dropping off a bit, but still substantially above where we were 10 years ago. So from where you sit, what were the big forces that took BTR to where we see it today and where it's going?
Yeah, I think, if you look at the chart, BTR wasn't really much of a thing, prior to 2020. Obviously, when housing, was kind of kickstarted in COVID, and it became more difficult, on existing home sales. A lot of real estate investors and SFR operators, and kind of pivoted to build to rent, because if you can't buy it, then you got to build it. So you can see, the starts, kind of at 40,000, last year, this year. And then kind of tailing off, and a big part of that is just where the market is now, right? So, in a lot of the high growth markets, you're seeing slower absorption rates, home prices coming down, rents leveling off or coming down, and that's what's kind of giving way to the lower starts, in the next couple of years.
Gotcha. And have you seen that in your day-to-day with the firms and stuff that you deal with and their inquiries?
Yeah, so a lot of the deals that we see, for financing requests on BTR are in, these markets like Phoenix and Austin and San Antonio and, other areas in Texas where there has been a ton of building and, there is a lot of oversupply. As we look at BTR, it's interesting, BTR versus, scattered site SFR operators, the biggest nuance is that it's more commercial real estate like. So, on the scattered site SFR, it's very easy to value those based on, resales and, comparables. In BTR, it's more based on cash flows, and, you're looking at it more like an apartment building. So as those absorption rates have slowed down and, rents, have come down, and there's a lot of concessions being offered in order to just get these units occupied, it becomes much harder to value the properties. And also as the cash flows have decreased, it becomes much harder to cover the loan proceeds that are being asked for. So as a result, there was a lot of building that went on in 2021, 2022. Material costs were much higher, and now you're seeing, values are below cost basis in a lot of instances.
And has that shift changed who is approaching you about BTR?
I think, I don't know if that's changed who's approaching us, because those projects are, they've already been built or they've already been planned and they're in the process of being delivered. But I think it potentially changes the strategy that they had going into it. They potentially have to, depending on who the client is, what their access to capital is, they may need more, additional equity to make the deal, to continue carrying the deal. Typically we're refining projects out of construction loans. Those construction loans had much higher values, 2 or 3 years ago when they were started. So, in order to pay off those construction loans and, cover the additional costs of getting new debt, typically requires some more money coming in, and, smaller size players generally don't have access to that equity, or it's going to be very expensive. Whereas the larger developers and operators typically have access to cheaper money, and they're able to more efficiently, kind of carry these assets through the more difficult times.
Gotcha. What about the builder side specifically? How has that shifted in the last 5 to 6 years from where you sit?
I think primarily these assets were coming from kind of your typical home builders. A lot of these were kind of merchant builds, or that were sold as communities. I think now you're seeing product come from a variety of players. So you have national home builders who have projects in their pipeline that were intended to go retail. That has slowed down given where mortgage rates are and kind of affordability. So they're looking at selling to more institutional type operators who will buy an entire community and operate it as a rental property. We're seeing SFR operators who own large scattered site portfolios who are now engaging with, they're either partnering with home builders to acquire land and develop it and build the vertical, or developers who are more opportunistic, who are experts in buying land and entitling it, and then they'll build the communities and then look to sell it to an SFR operator.
Gotcha. And right now in 2025, kind of where we're at in the BTR market, are you seeing more of these groups that want to build, lease up, and then sell the community once it's stabilized? That's like, it's cash flowing already and like mostly, full, or more groups trying to be those long-term BTR owner operators from the jump?
I think it depends on who the sponsor is. So and also where the capital is coming from. So generally there's, the kind of the development piece is going to be more opportunistic and more higher yielding, and you might have private equity, backing that is looking for kind of multiples on their investment, on an exit in whatever, 5 years or something. But then you have operators who are really building it just to have access to the homes. And in some cases, you have operators working with private equity who they may step out of the transaction once it's stabilized, and the operator would recapitalize it with, additional, with new equity, who may be okay holding it for 10 or 15 years.
I see. So let's look at another one of these charts here. I'm gonna keep flipping back and forth. So let's look at the map here. So this is I believe it's the 2020 through 2024 single-family BTR units currently in the pipeline. So that's things that are already built and things that were, in the process of being built and delivered. Obviously, as you can see, like the largest squares are, a lot of those metros that we've talked about today, across like Arizona and Texas and Georgia. But, you see these other ones as well, So I wanted you to speak a little bit to that and sort of like, who are these people that are going into, or these groups that are going into, all these other kind of in-between ones, the ones we don't hear about as much?
Well, I think it's, kind of all of the same folks. A lot of the, operators who are involved, kind of, just naturally how the SFR market, has evolved. Their footprints are in, kind of the typical Sunbelt, states, Florida, Texas, Phoenix. There's a lot of communities, from like the national builders that have, they're transitioning into rental communities. So they are participating all over, right? And then I think it's more local and regional players, and, smaller builders. I mean, we talk to people all the time that, they are home builders first and foremost, but, they see an opportunity, or maybe, one, it's could be difficult to sell out a community, and then two, I think most people are pretty constructive over the long term on single-family real estate, given like the supply-demand dynamics. So you have, smaller local and regional builders who, typically are building to sell, but they say, hey, maybe I can go, partner with, an equity provider, and we can hold these for the longer term. So, there's a lot of these people who are kind of getting in there, that weren't historically intending on, operating.
What do you think is
single-family
getting them in
rentals.
the door?
Well, I think.
Are you still seeing that now?
Yeah, of course, and I think I think a couple things. One, resales are harder. They're not 100% certain they could sell out the whole community, given where like mortgage rates are and the price points that they need to achieve. And then two, again, these are now trading on more of a commercial basis, as a community. And if you look there, cap rates are, call it in like the mid fives. I think, a lot of people see, runway to stabilize these, create, as much efficiencies as possible, and then potentially sell these, to a longer-term investor at a tighter cap rate and, kind of earn their money that way. So instead of just clipping their whatever 15 or 20% margins, potentially there's a lot more upside. And if they have capital, a lot of these builders, are, kind of generational families, and they're real estate families, and they'll keep their money in, and this will be their, their families, kind of, they'll pass it off to their kids,
Gotcha, yeah. And then we'll talk about this last chart up here, the one in the middle. So this is a scatter plot that we made here at ResiClub. The x-axis is the year-over-year population growth in 2024, and the y-axis is the recent BTR home footprint per 1,000 rental units. So it's kind of like a ratioed, just to measure BTR activity, like footprint activity. And you can see there is like a very clear correlation between population change and where BTR is getting built. So ultimately, would you agree it's a long-term bet? You're seeing rent softening, you're seeing, kind of like a little bit slower absorption in some of these markets that are still BTR heavy. Do you think that's still the mentality a lot of the people are coming to, where it's this long-term bet based on A, population, and B, like land availability?
Yeah, I mean, generally it's long-term outlooks on migration and, employment opportunities and taxes and weather in a lot of cases, right? So like you continue to have a lot of these areas where there's, people moving to them. So obviously they need houses. Like there could be the short-term blip where, oops, maybe we built way too many homes over the last couple of years, but over the next couple of years, those will be absorbed, and then we'll kind of kickstart, the building again in those same areas. Also, a lot of those areas are the places where you can actually buy land and build, right? As a lot of the, in the Northeast, right? It's very difficult to do that.
Yeah. So you really see both sides of the table when these deals happen. What's a gap you notice between how BTR builders see a deal and how their capital partners see it?
Yeah. So builders, their job is to build, right? So their expertise is, generally acquiring land, entitling it, building it efficiently. I think no matter what, they need to continue building, right? They've got to keep the pipes open. They've got to keep their subs employed. That's their business, right? So they need to continue moving just in order to, kind of stay afloat. And, maybe their margins are a little bit skinnier, but they know that, ultimately that'll normalize. So they're going to continue building it, maybe just earning less money. The equity that's coming in, they have a lot of options of where they can invest. And in order, right now you look at a lot of these deals and you see softening rents and slower absorption, and that's really how you're valuing these assets, right? So I think it becomes, they're looking for much higher returns, right? As the equity investors, it becomes, all the assumptions kind of have to be perfect in order for them to invest, right? And so they look at these deals now and they say, well, I think this is a 10% return, not a 20% return. So like, why would I invest? There's plenty of other things I could do at 10%, right? So I think that's kind of the issue that you're having now.
How much are interest rates right now a function of these decisions? And do you think that if they move down meaningfully, you would see an uptick in activity or questions about BTR?
I mean, interest rates are important, and obviously that helps, but I think these businesses function in low interest rate environments and higher interest rate environments, and you figure out how to make the deals work. There's a variety. There's always a trade-off between leverage and pricing, and you can go to a bank, you can go to a private lender, you could, there are options, And financing's, I mean, it's necessary to kind of get these projects to the finish line. So like, I don't know that there'd be a lot more activity. You know, I think rates are kind of in a okay spot right now. They're not crazy. I mean, we're doing loans in you know, 5s and 6s. I mean, that seems somewhat normal to me. So yeah, I mean, sure. If money is cheaper, people will spend more.
Yeah. And when a deal dies on your desk with, you know, regarding BTR, what was the most common reason, and what do you think could have been done differently?
It's funny because, again, like these aren't like prospective projects. These are projects that are already
happening,
built, right? Or they're in the process of being built. So deals don't necessarily just completely die in a lot of cases, especially right now. They just kind of get kicked down the road.
Reframing or, you know, a restructuring, yeah.
Yeah, I mean, look, in some cases, you know, a deal might be upside down and it's going to be distressed and they might have to sell it, or they might have to go find new investors. You know, in a lot of cases, you know, they have financing already in place and maybe it's not as favorable as they would like, but, you know, so they just kind of have to, you know, kick the can a little bit. But, you know, we do see a lot of deals that, you know, from a year ago that they couldn't make work at the time. Now they're coming back on our desk now. So like a lot of these, they never really die for good. You know, eventually something.
They come back to life.
Yeah, something happens to them, exactly.
Yeah. And can you tell me, you know, anything else that you've noticed just in this year? I feel like it's, you know, we look at this chart up here and it's a little bit of a pivotal year for BTR, and you see some of the interest start to go down a little bit. Can you tell me a little bit more about how that sentiment is being expressed amongst like the firms and stuff you talk to?
In terms of lower supply in future years, I think, you know, generally right now, I think it's viewed somewhat favorably in terms of, you know, from our aspect, right?
Yeah.
You know, because again, like all the projects that we're working on, we're trying to, you know, ultimately get stabilized, right? So like, you kind of need some of these, you know, some of the supply to come down in order to, you know, fully occupy these communities, and then, you know, obviously you can, you know, kind of build more. But, you know, certainly, I think the oversupply right now is the bigger concern than potentially some like undersupply in, you know, 2 years.
Right, yeah.
But the general thesis is that, you know, if you can get through the next couple of years and get some of these units absorbed, you know, things will kind of normalize, you know, in the next couple of years.
Are there any regional markets that you're hearing more about now, or is there anything interesting going on regionally? Like, is there going to be another Phoenix, another, you know, Atlanta with
Yeah, I mean, I think you kind of already see that happening. You kind of
now,
know what's like oversupplied, and you kind of see the, you know, you kind of see that already happening now. You know, and then I think that's also causing people to kind of look at other markets like the Midwest, for instance.
Yeah, that's what I was going to ask, yeah.
People really want to go there because like you can't build as easily. There's not as much land, you know, generally prices and rents like in the Midwest, Northeast are a little bit, you know, stickier. So, you know, you see a lot of people who really like those
How do
markets.
those projects look different than the ones in like the Southwest and the Southeast? Based on, you know, land restriction and population growth and that kind of thing.
Yeah, I think generally they're a little bit smaller, maybe less amenitized because you're not necessarily competing with like 5 of the same communities, you know, within a few miles of each other. There's just much less of this type of product in those markets, whereas like Phoenix, Texas, Florida, like everything's a, you know, gated community with a pool and a clubhouse.
The amenities, yeah. Okay, and we'll close it out. So if we fast forward to 2026 and beyond, what do you think is going to look different about, you know, who's getting in the mix with BTR and where BTR goes?
I think, you know, it's interesting. I think the bigger home builders are becoming more prevalent. Obviously, like their expertise is building, they're supplying a lot of product, and you're seeing a lot more activity from, you know, kind of the national home builders to institutions, you know, more so than obviously really ever seen before. It was never really a thing until the last couple of years. So I think you're going to continue to see that. A lot of the bigger home builders that we talk to, like that's a big part of their plan is, you know, being able to work with these larger institutions and, you know, either sell communities that they've already built, or also, they can take some risk off the table and they can work as fee builders for, some of these operators or developers, and still stay in the mix that way.
Gotcha. Thank you so much, Jaime.
Thank you.